Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Dominion Energy Inc. Annual Report. Dominion Energy Inc. offers a diverse range of businesses and services to its customers across the United States. At the core of its operations are regulated electricity and natural gas services provided through three main segments: Dominion Energy Virginia, Dominion Energy South Carolina, and Contracted Energy. The Dominion Energy Virginia segment serves approximately 2.8 million customers in Virginia and North Carolina by generating, distributing, and transmitting electricity to residential, commercial, industrial, and governmental customers. In contrast, the Dominion Energy South Carolina segment caters to around 0.8 million customers in central, southern, and southwestern parts of South Carolina, providing electricity generation, transmission, and distribution services. In addition to these regulated segments, Dominion Energy also operates a contracted energy segment that focuses on non-regulated long-term contracted renewable electric generation fleets and renewable natural gas facilities. This segment allows the company to diversify its offerings and tap into emerging markets in the energy sector. Overall, Dominion Energy's comprehensive portfolio of assets includes approximately 30.7 GW of electric generating capacity, 10,800 miles of electric transmission lines, and 80,400 miles of electric distribution lines as of December 31, 2025. With a rich history dating back to 1983, the company has established itself as a leading player in the energy industry, serving millions of customers across the United States. The list of businesses and services provided by Dominion Energy includes regulated electricity services, regulated natural gas services, electricity generation, electricity transmission, electricity distribution, renewable electric generation fleets, non-regulated, renewable natural gas facilities, non-regulated. Dominion Energy, Inc. stock price has seen a significant increase of over 17.17% in the past year, reaching a total return of 18.32% as of late February 2026. This rise can be attributed to several positive news events and financial announcements that have boosted investor confidence. One key factor contributing to this growth is the resumption of work on Dominion Energy's Coastal Virginia offshore wind project following a favorable federal ruling. This development has eased concerns about regulatory delays, providing improved execution visibility for the project and driving up stock prices by approximately 5%. The company's strong financial performance in the fourth quarter of 2025 and full year 2025 was another significant contributor to its stock price increase. Dominion Energy reported operating earnings of $0.68 per share in the fourth quarter, surpassing estimates, and full-year operating earnings per share of $3.42, exceeding its guidance midpoint. In addition to these positive financial results, Dominion Energy unveiled a significantly expanded 5-year capital investment plan, increasing it by 30% to $64.7 billion through 2030. This substantial investment is primarily driven by the surging demand from data centers in Virginia, further boosting investor confidence and driving up stock prices. The company's extended long-term earnings per share, EPS, growth guidance of 5% to 7% through 2030 also indicates a bias toward the upper half of this range for the years 2028-2030. This reaffirmation provides stability and confidence to investors, contributing to the stock price increase. Furthermore, Dominion Energy's reaffirmation of its existing credit and dividend guidance has provided further stability and confidence to investors. The company's increased institutional investor holdings, with major investors like Vanguard and the State of New Jersey Common Pension Fund increasing their stakes in Dominion Energy, have also contributed to the stock price growth. Dominion Energy, Inc. market capitalization of $55 billion is significantly larger than the average industry peer of roughly $6 billion. This shows that Dominion Energy, Inc. holds a significant advantage in their industry. Dominion Energy, Inc. trades at a higher price-to-earnings ratio of 21 times and a higher price-to-book ratio of 2.05 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 71% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 4.16%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified in the provided extract. On one hand, Dominion Energy Virginia and Dominion Energy South Carolina have experienced significant revenue growth, with increases of 10.6% and 15.5%, respectively. This growth is attributed to electric and gas sales revenue, which has seen substantial increases in both companies. In contrast, contracted and other has been a major driver of revenue decline, with a staggering -523.8% decrease. Additionally, the CVOW commercial project costs are not expected to be recovered from customers, resulting in charges of $108 million in 2025 and $77 million in 2024. These factors have contributed significantly to the overall revenue decline. However, it is worth noting that operating revenue has increased by $1,606 billion in 2025 compared to 2024, with electric fuel and other energy-related purchases increasing by $848 million, and other operations and maintenance increasing by $317 million. This suggests that while there are areas of concern, the company's overall revenue growth remains a positive trend. Dominion Energy's net income has shown a steady increase over the years, with a notable jump from $1,897 million in 2024 to $2,101 million in 2025. This represents an increase of $204 million from the previous year. The company's profit margins have also fluctuated, with a significant rise in 2024 to 18.6%, followed by a slight decrease to 17.9% in 2025. Breaking down the quarterly performance, Dominion Energy reported strong growth in net income from continuing operations in Q2 and Q3 of 2025, with increases of 14% and 26% respectively. However, this trend was reversed in Q4, where net income decreased by 49% compared to Q3. The operating revenue also showed fluctuations throughout the year, with a notable decrease in Q2 and an increase in Q3. The profit margins by quarter reveal that Dominion Energy's profitability varied significantly over the course of the year. While the company reported high profit margins in Q1 and Q3, it experienced a decline in Q4. The operating revenue also showed a mixed trend, with decreases in Q2 and Q4, but an increase in Q3. Overall, Dominion Energy's net income and profit margins have shown some volatility over the past year, with both increases and decreases observed. While the company reported strong growth in certain quarters, it also experienced significant declines in others. The company's ability to generate positive operating cash flow is a mixed bag. On one hand, there are instances where the company has achieved significant increases in net income contribution and operating activities. For example, on page 56, it is noted that net income contribution increased by $260 million from 2023 to 2024. Similarly, on pages 72 and 79, operating cash flow was reported at $3,514 million and $5,361 million, respectively, in 2025. However, there are also instances where the company's operating cash flow is negative or unclear. On page 105, it is stated that operating cash flow was a mere $97 million. Additionally, on page 163, while the company reports positive cash inflows from payments related to spent nuclear fuel, its overall operating cash flow status remains ambiguous. Despite these mixed results, there are some instances where the company has consistently generated positive operating cash flow. Dominion Energy and Virginia Power, for example, have have achieved this feat in all 3 years, as indicated by income tax benefits on page 109. Overall, while the company's performance is not uniform, it does demonstrate periods of strong operating cash flow generation. The debt levels of Dominion Energy and its subsidiary, Virginia Power, have seen significant increases in 2025. According to the data, Dominion Energy's long-term debt rose by $4.34 billion, 12.6%, while Virginia Power's long-term debt increased by $2.58 billion, 13.5%, over the same period. Additionally, short-term borrowings from Dominion Energy skyrocketed by 144% in 2025. The increase in debt levels has led to a corresponding rise in interest expenses for both companies. The weighted average rate for securities due within 1 year increased for both Dominion Energy and Virginia Power, indicating higher borrowing costs. Furthermore, the variable interest rates on new borrowings are likely to have contributed to the increase in interest expenses. Overall, the data suggests that the debt levels of Dominion Energy and Virginia Power have grown substantially in 2025, accompanied by a rise in interest expenses. The performance of Dominion Energy's segments varied significantly in 2025. On the positive side, Dominion Energy and Virginia Power were standout performers, with net incomes of $2,325 million and $535 million respectively. These results indicate strong financial health and growth in these areas. In contrast, the corporate and other segments struggled, recording a net loss of $300 million. This underperformance suggests that this area may require attention and improvement to get back on track. Overall, Dominion Energy's performance was mixed, with some segments excelling while others faced challenges. Dominion Energy's management is signaling a proactive approach to navigating current challenges and seizing future opportunities. To address inflationary pressures, the company plans to invest in assets and operating resources. Meanwhile, it will continue to meet its renewable generation development targets under the Virginia Clean Economy Act, VCEA, through various projects. In terms of risk management, Dominion Energy aims to minimize pension and post-retirement plan risks by diversifying funds among asset classes, investment strategies, and advisors. The company also expects climate-related disclosures to have no impact on its financials. Furthermore, it is exploring ways to efficiently monetize tax credits through third-party transfer agreements. In addition to these strategic initiatives, Dominion Energy is taking steps to manage its debt and credit facilities. It has increased its joint revolving credit facility limit to $7 billion and amended its credit facilities to extend maturity dates and increase letter of credit support. The company's commitment to meeting its renewable energy targets under the VCEA demonstrates its dedication to sustainability. Overall, Dominion Energy's management is focused on managing risks, investing in growth opportunities, and maintaining a strong financial position. This approach suggests that the company is well equipped to navigate current challenges and capitalize on future prospects. The company has made several strategic moves through acquisitions and divestitures. On the acquisition front, the company has purchased Green Mountain Power Corporation, Hopewell Polyester Biomass Power Station, and CVOW commercial project with Stonepeak's investment. Additionally, Dominion Energy acquired a 30% membership interest in Valley Link. In terms of divestitures, the company has sold several non-controlling interests to various entities. This includes a 50% stake in Virginia Power to Stonepeak, Questar Gas transaction, East Ohio transaction, and PSNC transaction. Furthermore, the company has also sold a 50% non-controlling interest in the CVOW commercial project to Stonepeak through an interest in OSWP. These transactions demonstrate the company's efforts to restructure its assets and investments. The company's financial activities have been marked by a commitment to shareholder value. One key aspect of this is the payment of dividends, which has been a regular occurrence. According to the records, the company has indeed paid out dividends in the past, with specific amounts detailed on page 79. In addition to dividend payments, the company has also engaged in share buybacks. This strategy allows the company to repurchase its own shares from the market, thereby reducing the number of outstanding shares and potentially increasing earnings per share for existing shareholders. The company's direct stock purchase plans and forward sale agreements are outlined on page 59, demonstrating a deliberate effort to manage its capital structure and reward investors through share buybacks. Supply chain disruptions pose significant concerns for companies. The extracted summary highlights several concerns regarding supply chain disruptions that could impact companies' operations. Delays in PJM interconnection projects, increased network upgrade costs, and contractors' inability to complete projects on time and within budget are all contributing factors. Page 28. Furthermore, the COVID-19 pandemic has already caused disruptions to supply chains, as acknowledged by the companies themselves. Page 31 and page 43. Moreover, public health crises and epidemics or pandemics could have a devastating impact on companies' business operations, including extended disruptions to supply chains. Page 34. This is evident in Dominion Energy's decision to write down certain materials and supplies inventory by $50 million in Q3 2024 due to supply chain issues. Page 137. These concerns underscore the importance of addressing potential supply chain disruptions to ensure business continuity and mitigate financial risks. Companies must be proactive in identifying and mitigating these risks to avoid significant losses and maintain operational efficiency. That concludes the financial summary for Dominion Energy Inc. Feel free to comment below, and I will be happy to answer them when possible.